Great. I want to shift the conversation to the individual investor. I'm sure our listeners, we all here have had friends or folks that we know who have started businesses. They all sound very promising. They all have wild valuations. It always brings me back to Shark Tank and Mr. Wonderful and saying, oh my God, where did you get these valuations? Which I actually think is probably the smartest thing he does, because they are wild, lofty valuations that people assign to these investments that absolutely have no business. And so when an individual investor, thinks about venture, I think they need to think about the risk premia of never seeing their money again. So, Tom has a successful real estate operation where if I give him money, I know that I could probably expect a return depending on what real estate asset class it is. Whether it's a development, I could probably see a return within 12 to 24 months, right? But it's a reasonable expectation. If he's buying something that's already an existing asset and perhaps it's a value add opportunity, maybe I start seeing money within 6 to 12 months. But the expectation of me starting to see a return is fairly, short term. And so, when I look at the venture space, I think a lot of the individual investors out there who get approached in these deals, to me, it just seems like just where the risk premium is for them never seeing their money again, and what the offer is, it just doesn't seem to really kind of provide any investment value. So I'm curious to hear from you as we kind of close this up. What should individual investors do in the VC space? How should they access it? And what are some things to look for? Obviously, you're not going to get into everything, but perhaps 2 or 3 items would be really helpful for our listeners.
Yeah, that's a great question. I mean, I think, the first thing most people talk about when it comes to individuals accessing VC is as an angel investor. And I think given what you said about the lockup periods and the illiquidity, as well as what we were talking about earlier in venture being a hits-driven business, you want to make sure you have a diversified enough portfolio to have a chance at hitting a winner or two. So typically 50 plus investments over 3 to 5 years is I think a good place to start. I think what's really risky is investing a high percentage of your net worth into 5 investments, which all could go to zero. Just not enough diversification, especially as an individual angel, where you might not have the brand or of a firm behind you and whatnot. You might not have access to the same deal flow. You might be dealing with more adverse selection than if you were the same individual at a firm. So I think diversification and portfolio sizing is really important for an angel if you're going to go direct into startups. The other way to gain access is there's crowdfunding platforms. I'm sure you're familiar with most of them. I've not really been a fan of that way, primarily because I think there's a lot of adverse selection on those platforms.
Give us an idea of what adverse selection is. I know what it means. Tom knows what it means, but break down adverse selection and what that looks like. What's the negative benefit or negative risk to the investor?
Yeah, I mean, basically just meaning that the best companies will often not list themselves on the crowdfunding platforms, and they might not, you might not ever hear of them raising. And if you do, you might not be able to get in as an individual angel with a small check. And so when you're looking at companies on a crowdfunding platform, you're probably looking at a universe of sub 5% of companies. And the other 95% really high quality companies are going right to institutions or to established names to raise. You're never looking at them. So you may look at a study that says, oh, if you invest a certain number of dollars in as an angel into venture, it's offered great returns and all these things, but that's assuming you have access to the whole universe. So adverse selection, I think, is it's a sliding scale. I mean, we deal with it as well. But on one end, if you're Sequoia, right, you deal with less adverse selection. And if you're an individual that no one's ever heard of, you deal with more. So typically what I'd recommend is like, you want to try to just minimize that as much as possible. So whether that's focusing on a domain that you really know, or focusing on relationships that you already have in your network, so you know that the reason you're seeing it is because of your relationship, not because no one else wants it, is really key.
Morgan, thank you so much for joining us. Tom and I are going to sit here and debrief, and we really thank you for taking the time to educate myself, Tom, and our listeners. And we hope to have you back on and chat more. And we'd love to hear kind of some of the success stories that you're able to share next time. So cheers to you, and say hello to the wife and kids.
I will. Great to meet you, Tom. Thanks, Mitch. The invite was fun, and look forward to doing it again.